Warren Buffett just sold a position that he just was adding recently, and it makes me say, Warren Buffett, what in the heck's going on? We becoming traders here instead of investors? Yeah, we got to react to this video here. In this one, there's just a little 1-minute clip, and I kind of give my perspective on that. And I got to give you guys a couple extra videos here for reactions, right? Next one up here we'll react to. Earnings will be better overall this year despite Fed action, says Stephanie Link. We'll react to that one. I'll give my opinion. Am I expecting that or something different? And then we're going to listen to the Professor Jeremy Siegel. He now sees a stronger economy post-CPI, so that should be an interesting one as well. And just so you guys know, the massive once-a-year Valentine's Day sale is going on right now. If you want access to that before it ends, that will be pinned comment down there. For everybody that's going to get the course, start in the fundamentals of stock market investing section first. If you need help understanding cash flow statements, income statements, balance sheets, anything like that, that's going to help you out immensely in that section. Then start at the top and work your way down, become a master stock market. And if you need help understanding how to value stocks, how to value growth stocks, how to model out revenue, future net income, all those sorts of things, valuations, right? If you need help understanding all that, this course helps with that immensely, as well as you get the Dividend Investing Mastery course, and you do get lifetime access. So if you want access before the sale ends, check out the pinned comment down there. Let's jump into this.
Mid-November, we told you that Berkshire Hathaway took a big bet on Taiwan Semiconductor, an over $4 billion stake. But that happened in Q3. Well, we're finding out today from the 13F that it cut its stake by 86% in Q4, ending December. So the stock...
Wow, and look at the move down after hours now that the news is breaking that Warren Buffett and Berkshire did sell out.
Is reacting in the OT right now, down almost 4%, but on light volume, as we learned that Berkshire sold out of most of its position out of Taiwan Semi. So
it could have been Berkshire was selling all right here because they technically sold in Q4, and so sometimes you get this data that lags, which would make a lot of sense why that stock was seeing so much selling pressure throughout that time period. And what's crazy about this is Warren Buffett and Berkshire just missed a crazy money opportunity here. Because look where Taiwan Semiconductor has gone. I mean, oh my gosh, like just think if they just held through. Like the thing is, you got to understand when you're making positions that are several $billion, this is several $billion of lost profits for Buffett here, right? That's significant.
Shows how hedge funds just move in and out of stocks. Berkshire also cutting its U.S. Bancorp stake by 91%. Stock not really reacting so much. And then also shed some McKesson shares. This, though, very important for our viewers, happened in Q4, so not reflected of this current quarter. But I do have data for the current quarter, and that comes from 13G filings, which shows when a company takes a 5% or plus stake in a firm. Berkshire did cut its stakes in Activision Blizzard this quarter, as well as Bank of New York Mellon this quarter, and lastly boosted its position in Louisiana Pacific this quarter. There you go, Scott.
All right, Christina, thank you. We'll see you in a bit. That's Christina Partsinevelos.
Interesting. So it almost makes me think in terms of the Taiwan Semiconductor move, maybe that wasn't really a Buffett move. Maybe it was Todd and Ted. If you don't know how Berkshire Hathaway works, essentially, you have Warren Buffett, who makes a lot of huge moves, obviously, and he's still very into whatever Berkshire's up to. But then you have two other gentlemen that run money. One's named Todd, one's named Ted. I know, very basic names, right? Todd and Ted. And by the way, shout out to the Todds and Teds watching this video. That sounded like I took a shot at you, man. I'm not taking shots, and I want no smoke with any Todds or Teds. I appreciate y'all out there, okay? Thanks for being here. Thanks for being subscribed. That sounded wrong, okay? But nonetheless, I'm thinking that's probably a move from them because, you know, when you think about it, would Warren Buffett really buy a semiconductor company, right? In terms of the most Buffett-related stock, the most Warren Buffett-related semiconductor company would be TSMC, right? Like they're the ones that are producing for all the different semiconductor companies out there that are fabless companies. So if there was, it makes sense that would be a Warren Buffett stock, right? But to see them dump like that, just, you know, and I don't know if they even made money. That's the thing. They added that position in Q3. If they exited it almost completely in Q4, while they were dumping those shares, there was like no buying pressure on the stock. I don't know, like, you know, we don't know for sure, but the more I'm thinking about it, I don't even know if they made money. And man, if they just held through, I mean, you know, there would be at least $1 billion profit right now. Likely, okay, likely at least $1 billion profit, if not a $2 billion profit they'd be sitting on right now. So they should have just been a little more patient with that. But Todd and Ted, they do a little more trading activity versus Buffett. Buffett's looking at things for the next 100 years. You know, even though he's almost 100 years old, he's looking at things for like the next 100 years. Todd and Ted, these guys, man, they're much more traders. They're running Berkshire a little more like a hedge fund. And so, you know, sometimes people have to look at that. Do you want to own Berkshire Hathaway knowing that, sometimes they're not even going to be investing in companies. They're going to be trading. You're in and out of a stock in a quarter or two like that. That's a trade, man. That's not an investment, okay? Next one up here. Earnings will be better overall this year, says Stephanie Link. And let me react to this one and give my perspective.
I start by saying this. I'm really happy with the market response today. I mean, this is not a freak out day. I mean, yeah, it was up, it's down, but this isn't like, if we did this over the summer and we had a hot reading like this, and I do think it was hot, the market would be down 2-3% and be crescendoing in the day. This just feels like maybe the market is starting to take inflation in stride. Now, as for the actual number, I'll tell you right now, I didn't like the 0.5% month over month, right? Because prior to that, you had 6 months that in total, when you're looking at the month over month, it was up 0.9%. Now
energy
you get half of that in 1%.
Food ticked up.
Energy and used cars. Energy and used cars. Okay, so
used cars went down. No, used cars went down.
I'm sorry, then
energy ticked
cars.
up and food ticked up. No, a lot of that was due to eggs, but still,
so
inflation is.
I'm sorry.
Sticky.
The detail got missed here, okay, which is that if you look at fuel, right, it's come down since then, all right? If you look at the overall trend, we are where we were a year ago, just before the Ukrainian invasion in terms of gasoline prices. So you had this blip up in January, but it's reversed. And what it looks like to me is, yeah, this is a little hotter than I would have liked it, but it doesn't look like the overall trend in declining inflation is down. Last thing I'll say on this. 7 months, okay? 7 months, you look at it, the headline CPI is up 1.9%. Now, I know, and we all know, the Fed's looking at core services ex shelter. Here's what's going to happen. If they keep focusing on that while the headline is moderating nicely and they start putting people out of work, nobody's going to give them credit for core services ex shelter. They're going to say, what are you doing? You're putting people out of work while the headline's getting better. They're going to have to play the political tune here pretty soon.
So let's do this. The yields have moved up somewhat significantly, right? The rates.
In terms of inflation, from my take, I don't even want to share that really in this video because I'm sick of talking about that. I talked about that on the main channel here today and gave my take on CPI, what it all means, where we're going from here. I talked about all that on the main channel here today.
It is in lockstep with the Fed now, isn't it? If you look at
a big story.
If you look at Fed funds, that's in lockstep.
Yeah.
If not a little hotter than where the Fed itself is. I want you to address that, and then we're going to get to the issue of whether the stock market is in denial or delusional. But you talk to me about what's happened in the rates market.
Let me put some, I don't know if Jim intends this context, but the context of the market doing okay today is in context of what's happening in the rates market. That, to me, is what makes it okay, not terrific, obviously. But if you take a look at the 2-year, the 6-month, anything like that, sharp increase in rates in the wake of this. And what's happened is this dramatic story, Scott, of, let me give you the context to that, which is we've been talking about this gap between the Fed and the market for the year-end rate, where the market had built in all these cuts. And those cuts have now gone away, and the market came to the Fed. I'll show you 2 charts now. Guys, the multi-bar chart I got in the back, the Fed rate outlook is the first one. You can see what's happened here. First of all, for the peak rate, the market has gone beyond the Fed here. The green line is the Fed, folks, or if you're playing this game at home. And look, the market is now above that 513 average Fed forecast for the August contract. And then look at the year end there, 5.8, it's just 5 basis points separates them now. That was 80 basis points. You can see that more starkly in the next chart, which is the year end rate back on the 18th of January, which is low for the year. The market thought they'd end the year at 434, 70, 80 basis points of cut built in. That's gone away. So now the market has come to where the Fed is, and now the stock market has to adjust, and that's your game, not mine.
Does it need to adjust? No, but that's the big setup.
Well, it's adjusted.
Does it need to further adjust the stock market?
Yeah, it does.
Before I would say one thing that's worth pointing out here is the risk no longer is the Fed doing less. The risk now is the Fed doing exactly what it says or more.
Especially with
that's where the risk.
Okay, before they go further here, I want to make a point that I think is very important, right? Because you heard the gentleman that's hosting this, right? Which I can never remember his name. Scott Wagner, right? He's hosting this. And did you hear how he framed that question to that gentleman, right? Steve Leisman. He framed it in, is the stock market in delusion, right now? And my take on that is, was the stock market not delusional last year when it sent Netflix stock down 70+%, when it sent Meta stock down 70+%, when it sent Tesla stock down 70+%, when it sent Shopify stock down 70+%? And it was sending the greatest companies in the world that have unbelievable futures in front of them, right? Palantir 70+%. Like the list of stocks that got obliterated 70% plus, right? For companies that have insane opportunities in front of those companies for the next 5, 10, 15, 20 years. And the stock market sent those stocks down 70+%. That's a stock market in complete delusion. Those stocks should very rarely go down. And when they do go down, it should be like 10, 20% type pullbacks. Not 50%, not 60%, not 70%. That is delusional. That is way too caught up into just a fear moment in the market, right? A capitulation panic in the market. And that's what happened, right? And obviously, buyers like myself and maybe many of you guys, we have to step out there and buy a lot of those companies trading at silly prices. And believe me, many of these companies are still trading at silly prices. There's tremendous opportunities all over this market. And there's going to continue to be tremendous opportunities in this market this entire year, okay? The opportunities aren't going to be as good this year as they were last year, but there's still going to be so much money to be made in this market. It's ridiculous. And you have to work with urgency when you get these sorts of markets. Because many of these stocks, folks, are still down 40, 50%. And they have tremendous next 5 and 10 years in front of them, right? So the bears want to get you caught up into everything that's going on short term and trying to get you distracted and getting you to sell at bad prices. Because we know the game they're playing. They're playing a game of getting absolutely wrecked right now in the market. The longs, we never got wrecked. We went down in our portfolios, down in our accounts. Big deal. Big deal. Like, there's just more shares for us to pick up. We don't have to make a profit today. We don't have to make a profit tomorrow. As long as we're right over this next 3, 5, 7 years, that's all that matters, right? And you look at some of my greatest stocks ever. Like, look at how they performed over a 3, 5, 7 year span. Look at Tesla. Look at Elf, right? Look at these stocks and how they do over time. That's what matters in this game, right? The short term, the 1 year, the 18-month outlook doesn't change. But for a short seller, you have to make money now or you're done. You're finished, right? Because next thing you know, that stock doubles up and now you're down, you've lost everything. You lost everything in that stock.
It's tilted now.
Especially with that lodging away from home number of 7.7%.
Yeah, but seriously, what
that's services, and services we know is 73% of core CPI, and that number remains extremely hot. And that was the thing for me that stood out of all of these numbers.
So what does it mean for the stock market?
Look, I mean, we've seen this year, we've seen growth outperform value, largely because people thought that the Fed was going to eventually pause and then pivot, right? And we would see slower growth. Well, we are going to see slower growth, but the Fed is not going to change their tune anytime soon. Not with all of these numbers. Headline, core, super core, like I just mentioned, services.
So is that trade now in big trouble? Because Leisman today on Squawk said about the cut pivot story, the cut story's over.
Yeah.
That's what you said, right? That ship has sailed, or yesterday's news.
But Scott, I don't think this is terrible, right? Because I think earnings actually matter more. And earnings actually have been okay, not great, right? 80% of the S&P 500 report, 69% have beaten.
Yeah, but that doesn't matter.
Fine, maybe. Yes, it actually does.
No, it doesn't. If you look.
Yes, it does matter, sir. Okay? Yes, it does matter. She just brings up 69% beat. And think about this, folks. This is so freaking important, okay? Think about this. 69% of companies just beat. On an earnings season that was supposed to be horrible, trash, awful, trough earnings, bad, right? That's what we got drilled into our heads. And almost 70% of companies have beat their earnings, right? With another huge amount meeting earnings. In this environment where companies' margins should have been destroyed, revenue growth is not strong, and yet so many companies are still beating, right? It's incredible. That goes to just show you the strength of the best companies in the world and how those companies can still execute in some of the toughest environments you could imagine, which 2022 is the toughest environment I've really seen companies have to deal with. I mean, obviously 2020 was its own thing, right? But prior to that, really the great financial crisis. And I could make an argument that 2022 was a much tougher environment to operate in than actually 2008, 2009. And the reason being is you didn't have to deal with the cost of your products going through the roof. Transportation being sky high, shipping being sky high, everything, right? That's a whole host of other problems you have to deal with on top of a slowing down economy. That's a whole different dilemma you have to have there, right? So if I say anything, I say bravo to the CEOs and the executives out there in navigating in that sort of environment, and nearly 70% of companies beating for the most scary earnings period we've had in a long, long time. It's impressive.
But earnings growth actual for the fourth quarter is down 3.7%, and it's still trending lower than that.
Well, its
right?
expectations for the full year
are at 1.5%, or at 1.5%.
Right. 0 to 2% is what is expected.
Where was it on January the 1st? It was 4.5%.
Okay, but I think actually as we go through this year and we get the supply chain issues solved, we have inflation that is parts are coming down, even if it remains elevated. You have the dollar also down about 10%. I think also demand has been a little bit better than expected. I mean, look at Coke this morning, right? I mean, that organic growth of 15%, that's demand. Right. So to me, and that's just one example. I can give you a lot of other examples in terms of earnings. So it is a stock picker's market, and you have to pick and choose and see which companies have pricing power, which actually have seen better demand. And I think earnings as a result I think they're actually going to be better than expected for the full year. Maybe the first quarter, second quarter is a little soft, but I think you're going to see a little bit better throughout this year. And that to me is the most important thing versus what the Fed is going to do.
I agree with her 100%, and I've been talking about that. And that's the issue with trying to get this market down, right? And I've been talking about this a lot recently. If you look at how the S&P 500's weighted, right? If you look at how the NASDAQ 100's weighted, you need the biggest 15 stocks to basically have bad earnings this year and have like earnings being down. But if you look at the top 15 stocks of the, top 10, top 15 stocks of the S&P 500 and the NASDAQ 100, I actually believe the majority of those companies are going to have their EPS and net income go up. And some of those go up quite substantially. And that's something the market's just not even like ready for right now. A lot of people think it's going to be a flattish or maybe very slight growth. When I'm looking at a lot of these companies' margins in profitability as it goes throughout 2023 is actually being in a stronger position, right? And if you talk about big money, right? If we really want to talk about the billionaire class, the folks with, they can really move this market and shake this market around. A lot of those folks aren't the most academic types, okay? They're just not. The people that work for them are the most academic types. The billionaire class, they run on common sense. A lot of them have a lot of freaking common sense, okay? And what a lot of those folks understand is these price increases that we've seen are not sustainable. Eggs going up 70%, it's not sustainable. Egg prices will go back down. And in terms of all those commodities that doubled up, tripled up, and went through the biggest bull cycle we've seen in pretty much almost ever in human history, but certainly in decades, right? It's not sustainable. And so anybody with common sense understands this. And so if you're wondering why the market keeps going up from that October bottom, right? And it's just been going up and up and up since then, it's because big money's out there buying again. And they understand and they work with common sense, and they understood when they were ahead of the game in terms of how bad everything was going to get, right? And now they're ahead of the game on the other side. And then all of a sudden the CPI prints are going to come in better and better throughout the spring and throughout the summer. The Fed's going to stop raising rates. There's going to start being talk about cutting rates. Earnings I think there's a decent probability earnings will strengthen as 2023 goes along. That's a decent probability, actually, outside of some freak event. And that puts all of a sudden the market in this position where it's like, oh my gosh, they got it right again. Big money got it right again. As they do every single time, basically, right? Wall Street's wrong most of the time. But big money's right almost every single time. When you see a several-month trend, they're leading you to where earnings are likely going and where market sentiment's going to be going, okay? Next one up here, Wharton professor Jeremy Siegel sees a strong economy post-CPI. Let's hear what he has to say.
First report that really wasn't better than expected over the last 3 or 4 months. What I like is that finally Jay Powell is talking about housing in his data, realizing how distorted the housing data is in that CPI. So lagged, it's, up 710, when all the, actual apartment, Zillow, apartment list, Case-Shiller indexes are all going down. Actually, I've constructed my own core and regular CPI using actual housing and rental prices. Core inflation has actually been negative over the last 4 months. If you actually put in what's happening in the market. Now, at least Jay Powell is now trying to talk about ex-rental because he knows how distorted that is. And by the way, as Stephanie mentioned, if 40% of the core is housing shows 0.7%. When you do the math, 0.3% of the increase of that 4/10 increase was due to the distorted housing data that you actually had. And that's taking it out. If you actually put in a negative number, you bring it down to -0.1%. But I
wonder if you will admit that you've been too bullish, that you've been making the argument that inflation was basically going to fall off a cliff and come down in a near straight line. In fact, today's report proves the opposite of that and suggests, if anything, it's going to be a lot lumpier than some of the more optimistic people have expected or thought.
Well, first, we have to realize, it's interesting, the impatience, I think people, it's less than 1 year since the Fed started tightening. March? First Fed
That's true. It has actually been, it seems like it's been 100 years, but he's making a good point. By the way, let me know in the comments, what is this back here? Is this San Francisco? I'm having trouble telling what that is back there. That picture. Let me know if you guys know I don't know. I don't know where that picture's from, but anyways.
Increase. I remember when I went to school under Milton Friedman, he said, it's 12 to 18 months before you can get any effect on prices. We've had a lot of effect on prices in the first 12 months. And people are all upset because it's not down to 2% after, tightening started 11 months ago. This is a long process, to be sure. And it's a process that the Fed has to let go through the market rather than stomping on it so much to get it down to 2. And then, yes, I did and worry about the consequences. And yes, that January report on labor certainly surprised me. I'm not going to deny that. And really, what does that bring up? The no landing scenario. Why is the stock market holding up? You guys have said it. It's because really, if we don't have a recession at the second half of this year, earnings are going to be set to accelerate into 2024. Is that bad for the stock market? No. Remember, on the first trading day, I was on Squawk Box.
All right, real important before he goes any further, because he just brought up a great point, okay? The market is believing more and more now in a soft landing. Okay, not everybody's in that camp, clearly. And if you watch CNBC, for the last month or two, a lot of these folks are still in the camp that we're going to have a recession. Some are in the camp it's going to be a bad recession. But there are more folks starting to believe in the soft landing. But what he just spoke about, the no landing, right? That's a scenario like almost no one's even thinking about, right? Which is, what if everything stays just fine and earnings continue to strengthen throughout the year like I just spoke about previously, right? What does that mean for the market? I'll tell you what that means for the market. That likely means the market would be at all-time highs by the first quarter of 2024. All-time highs. NASDAQ, S&P, and the Dow, and the Russell. All-time highs by first quarter of 2024. If that's a scenario that plays out. We still got to get there. We just got a long, let's call it climb ahead if that's going to happen. But if that does happen, we will be back at all-time highs on all the indexes by the first quarter of 2024. So basically around this time next year. Think about that for a moment, right? Not a lot of people are expecting that. But as we saw in 2022, a lot of people aren't expecting a lot of things, and things can happen out of nowhere, right? And that goes for the good side and the bad side. And in 2022, we got the bad side of that. Whereas the market was far worse, the Fed had to raise far more, and inflation was far higher than anybody expected, right? And that was a tough year to be along out there. If you're thinking about your short-term account in what it says for pricing, obviously a great year to be a buyer. But, you can see that play out just the other way in terms of the good side. And wow, things keep coming in better than expected. So is that a possibility in 23? It's certainly a possibility.
In the morning before the market opened, and I'd
call it a decent probability.
What do you think the stock market's going to do this year? I said 10 to 15%. They thought that was crazy high. And they said, yeah, and that's in the second half of the year, right? I said, I'm not sure it's in the second half of the year. When everyone thinks the first is bad and the second is good, I often think the opposite. Well, we've had a 7.5% return to date, half the prediction that I made for the year already.
Right, but you've also made the argument that to fit into your thesis on how successful the market can do this year, that the Fed's going to cut rates, right?
Yeah, well,
I got Leisman sitting right to my right, who I want to get involved in this conversation too, who says that ship has sailed, Professor.
I don't think it's sailed. I am still worried about the cumulative effect of the tightening. And by the way, I don't think the Fed. Well, Steve said it's where the Fed is now. Actually, the chart he showed is where the Fed was in December. We will find out in 5 weeks where the Fed actually is now, as far as that's concerned. Yeah, I will admit, I was very worried that they were slowing things down too much. The January data on payrolls was like unbelievably good. We know it's unsustainable. I still think we could get a reversal, maybe even negative data in February. We'll have to wait and see what that actually comes. But yeah, I do see a stronger economy than I saw 4 weeks ago.
Yeah, in terms of the economy, okay, this is important for everybody watching this video to understand this. The economy can turn for the worse or for the better pretty quickly. We watched this play out in 2009. 2009, basically the economy kind of bottomed out in the first half of 2009 and then came back and companies started reporting a lot better earnings in the second half of 2009. And by the time you got to 2010, companies were reporting very solid, great earnings again. And it was like, wow, that happened pretty quick, okay? And some say, oh, it's because the Fed changed course. No, it wasn't just because the Fed changed course, okay? It doesn't work like that. It takes a while for things to take effect. But the economy got rolling again, right? Companies got their earnings back. They cut employees, right? Something we saw a lot in 2022, especially from the tech sector, obviously. Companies cut, got their expenses in line, and next thing you know, EPS started to trend up. And so that's what I'm talking about. Like, I think most of these big tech companies are going to see their earnings per share get stronger as 2023. And I think a lot of them are going to show extraordinary earnings per share growth year over year versus 2022. I'm talking 30%. 50% type numbers for some of these companies. Don't be surprised if in some of these quarters in 2023, companies like Amazon and Meta have 30 to 50% earnings per share growth year over year. Later on in the year, talking like Q3, Q4 type time. Don't be surprised at all. Maybe even, dare I say, 100% earnings per share growth. Okay, just wait on it. They had a lot of huge expenses that killed the earnings. They were overstaffed. And they got hit by, just obviously, business that was a much weaker in climate than they were expecting. If you're talking about the business climate getting better as the year ticks on and you got far less expenses, oh my gosh, like what that does for your bottom line is it's out of this world, okay? And so anyways, we'll see how it all transpires. Hope you guys enjoyed this video. As always, if you're looking to invest in yourself here today, well, we got the sale going on. Take advantage of that and learn lots, folks. That is my #1 course ever, Becoming a Master of the Stock Market, and my second most popular course ever, Dividend Investing Mastery. For access to those, that will be pinned comment to those to get it before it ends. Appreciate y'all. Much love and have a great day.